What's going on, guys? FX Brawler here. In today's video, I want to answer two questions from subscribers. And by the way, I love when you guys ask questions, because it gives me ideas for videos. And I want to make videos that are helpful to people. So keep asking questions because I'll answer them if I have time. So the two questions is one of the questions was I'm paraphrasing, but around where do you put your stop loss, and are the big guys trying to hunt the small guys, and how does it work in the market? And the second question is regarding Fibonacci levels. When do I use them? If I use them, and what is the place that Fibonacci levels have in my trading personally? And I'll try to cover these two questions in the video. So first, let's start with stop losses. So the way I approach stop losses is I don't really know what the market is going to do in the vast majority of times, like 95% of the time, I just see randomness and I have no idea what's going to happen. But once in a while, I see a pattern that I know, and then I go active, if you want. I start to pay attention. And this is a recent example. I've made a couple of videos about this Bitcoin price action here. So in this case, let's say, uh, let's say it does a spike like this. My first reaction is, okay, first, this looks like distribution. I've talked about this before. So now what's the next step? Well, the next step was to go and breach the support level over here and to the downside. And that was the confirmation of the short. And the way this works is, let's say the market wants to break a level. Usually it will do some type of accumulation towards the level. So what I mean by that is that you will see a lot of candle bodies near the level that's going to get broken. And this means that there is a pressure on the downside because the price is not able to go up because nobody's willing to buy at these levels, and there are more sellers pushing the price down. So the it's basic uh, demand. Um, so what I see now is a pennant, which is this little rectangle here, and as this got pushed down, then we have a breakdown on the downside. So let's say I short this because I see that the market is putting pressure on the downside. Then the obvious stop loss would be above that structure. So to answer the question is, where do I place my stop? To me, it's wherever I see a structure that I know and that I identify and that will um, break my thesis. So, for instance, in this example, I see two places where I would place a stop. So, let's say I had a big order, I would have shorted in this zone. I would probably have shorted more towards the middle, but that's a different topic. But let's say I'm short here and I see it breaks on the downside, then I think it's going to come and test this. So my first stop would be above this structure, because if ever price goes back up, then what's to say it's not going to go all the way up over here to test the next level, which is this one here. So that's stop one. Stop two would be if the bigger structure, which is a distribution pattern, sometimes these distribution pattern end up just being a congestion area onto a larger time frames, because what you're seeing here as a distribution on a bigger time frame, it might look like a pennant or um, a, um, a triangle or a megaphone or something of that sort, but maybe there's a long leg on the upside and then a distribution pattern, and then it breaks the high and keeps going. So you always have to play these patterns as if they are a probability rather than a certainty. There are no certainties and no patterns work 100% of the time. So the next stop would be above this zone here, above this other pattern, because if this pattern gets broken to the upside, then we're going to the next level, and then you would have to zoom out on a bigger time frame and look at where the, like right now we're at this level, we tested this, it's getting rejected, so it's going to need to gather some momentum and accumulate more participants in order to break through this level here. So what's the next one? Well, the next one is here, and then the next one is somewhere around here, and then the next one is here, which is the all-time high, basically. So now if you zoom down on your 4-hour chart, you got your level here. So next level would be 52,000. So now let's go into the Fibonacci question. So Fibonacci, you know, it's everywhere in the world, and I once got deep into Fibonacci maybe 20 something years ago when I was learning about trading, and I was seeing these patterns everywhere in nature, and I really got absorbed into it. But eventually, as I was working as a high frequency trader back in 2008, 2009, in that zone, I realized that the only thing that matters is the next support, next resistance, next support, next resistance, and you keep moving from one to the other. And if the theory of Fibonacci is true, then the levels are already established on a Fibonacci level as supports and resistances, because if prices move from one Fibonacci to the next, then these are already represented in the past and I can find them. So there's kind of this chicken and the egg type of theory, if you want, with Fibonacci levels. But sometimes I use them and I'll show you, like for instance, if I don't see a level at the bottom, let's say a stock is fairly new and I don't have a lot of data, then I will use Fibonacci levels as guidelines as to where market participants might take their profits or start buying. But if I can see clearly supports and resistances, then everybody can see the same thing as I do. And I don't need to have another fancy tool in order to tell me that the next support is there and the next resistance is there. So that's the short answer. I rarely use them, but I do use them in some instances, and I'll show you an example. Like I've been long. A few years ago, I took a trade on several uranium companies, and I made a killing. And I got out of the trade, and I got back in not too long ago, and I want to show you this trade here, and I want to show you because this is another thing that bothers me sometimes. I look on YouTube. I like to look at what other YouTubers say about trading, and I see and because of that, I watch the ads of certain people are being fed to me in my feed and I was watching an ad recently where the guy was saying that do you think that profitable traders use technical analysis? That's not what they use, and blah blah blah. And I was like, dude, technical analysis is still as valid today as it was 100 years ago. Like it still works, but you have to be accepting of the fact that it's very you have to be on the sidelines most of the time and really pounce whenever you see the pattern. So what I want to show you here is the this trade here that I took on uranium and the way I traced it, and we'll talk about Fibonacci and we'll talk about stop losses. So I was seeing this pattern here, and let me see where I got in. So my average price is 3.2567, so $3.26. Let's find that. Let's say 326. So I bought the exact tip of that test of the support. And if you've been watching my channel, you know I love triangles, like they're my bread and butter. And that was traced just with these two highs, and I made an extension, and now I've been long because what we saw was the explosion. I'm trying to think of the other stocks that there was a Cameco. You can look on my in my history, but this is something that I went long on very, very early, and you had the same type of situation where you had a triangle, you had a big change in supply, like it was, and then it broke to the upside, and I went long in that zone here, and it's the same principle. So you've got a long. This is an accumulation pattern, long accumulation, and then we saw the snap, if you want, where nobody was willing to sell anymore, and for more buyers, and there was a supply shift. And then we saw that big long thing, and then I looked for, and I got out in that zone around here, and I didn't get back inside of that trade. So I was looking for other trades to get back into, and there was this one that I found on Uranium Royalty Corp. I'm not sure if it's on the U.S. Stock Exchange, but anyways, royalty corps are a topic for another video. But royalty companies, I mean, but they're a really good business model where you have very few employees for the market cap that these companies can reach, like Franco-Nevada being a good example, or Wheaton Precious Metals. And these are good companies to, if you have a bullish outlook on a field or a mineral or things like that, I tend to buy royalty companies because the price can go up and up and up, and they tend to grow instead of buying outright the mineral. But I'm going on a tangent here, sorry. So price broke out, it tested here, I went long the world, and now I'm already up 51% on this trade, and I use technical analysis purely. And the next thing I want to talk about is these Fibonacci levels. So now what do I do? Because I don't have a map of resistances. The stock didn't exist. The stock is started here in 2020. It's a fairly new company. So then I will look at some extensions. So let's say here. So now what are we looking at? The next supports and resistances, we got a 1.618 here, and we got a 2.618 here. these would be long-term levels that I would look at and that I would think of taking some profits off of the table. So, and by the way, this is not financial advice. Don't sue me if you lose money on this trade. This is a trade that I took, and I'm trying to teach you a concept rather than giving you a signal. This is not what I'm about. You probably know that by now. But basically, if I go in here and it goes to 12, I've quadrupled my money. And when I was starting in trading, and this is a different topic, but when I started going into trading, I thought that I would make a fortune by trading 200 times a day on the same stock or on Forex and things like that. And what I didn't consider back then is that you may think you'll shortcut by doing a lot of trades, because it makes sense that if the stock moves $30 in a day, and there are multiple moves of $5 up and down, then you could potentially make more than the move of the stock, $30 or 30 cents or whatever the price range for that stock. But what I didn't realize back then is that it's very difficult to time these right, and it's very difficult once you're in a good trajectory and you make a lot of money in a very short period of time. That kind of stuff plays with your mind, and you have that little God complex where you've got this, you've got this all figured out. And I remember that when I started, when I was a high frequency trader, um, I would make sometimes 150, 200 trades on a single stock in a day. And my best days were always followed by my worst days. And it's important to keep in mind that the shorter time frame you use, the more your emotions and your mind will play games with you. And I've made lots of money for months sometimes, and then I've lost a lot of money quicker. And that happened several times in my life, and every time I had to go back to work to get it, but I knew I was close because I had just made so much money that I couldn't even believe it. But then I got um, that little voice, that little thing on my shoulder saying, keep going, and all you need to do, what I'm trying to say is that all you need to do is have a few of these good trades, of these good setups that you wait, and you patiently wait. And when the time is right, then you go for the jugular, and then comes the next waiting period. And you can make hundreds of percent in less than a year, and beat the market this way. And it's not easy. There's still a mental aspect, but it's a lot less risky, because even if the stock doesn't pan out and it doesn't go to the moon right away, I still haven't lost all my investment. And I don't have a stop loss right now, but the point at which I would put my stop loss, which is going back to the first question about stop losses, is I would look at the pattern that I'm currently trading and that I currently recognize, and I would place my stop somewhere below that pattern. And as the trade progresses, what I'll try to do is to protect my capital. And the way I do that, but this is tricky because sometimes you get stopped out of the trade and it goes in your direction after you get stopped out. But eventually, as price does these types of moves, eventually what I'll do is, let's say my stop loss starts here. Eventually, as I break new highs, let's say this new high is broken, then I would probably bring my stop at my entry point. So now I have a risk-free trade, and I can start to allocate capital elsewhere in my portfolio and not consider that I'm over leveraging into a sector. So if I protect the first entry on that specific uranium stock, then I might be able to look for another uranium stock without increasing my exposure to risk. And that's into the money management sphere. But basically, it's probably a long video, but you know how, my style by now. I just talk and I have a bunch of ideas that pop in my head. I'm trying to share. What I want you to remember from this video is I use Fibonacci levels whenever I don't see a clear support or resistance ahead. Otherwise, I just use simple supports and resistances. And as far as stop losses, I use structures. I use patterns that I know in order to negate my view. So I thought that was a long because I saw a long distribution pattern and there was still buying pressure. And then when price broke out of that pattern and then tested it, I took a chance and I went long. And now I need to wait. And if ever I see that this pattern is broken to the downside, then I will know that I was wrong on. I wasn't wrong, but I was. The pattern didn't pan out because you just because a pattern didn't work once doesn't mean it's a bad pattern or that you were wrong. I executed the trade perfectly. This is a perfect example of a good entry into a trade with minimum risk, but it's possible that the market is going to reverse for whatever reason, and then I will have to exit. It's just the way of trading and investing works. So I hope this was answering. It's a long form of video answering a question, and I'll see you in the next one. Peace.